It looks like we've got a good sized audience. So Ben, if you want to go ahead and get started, I will keep this up until you move over to Victor.
Thank you very much. Welcome everyone. I'd like to introduce you all to Cherre's new economic real estate and tech trends webinar series. This webinar series is one in which we're going to explore what's going on in the economy right now, how these trends impact real estate and the role of technology in either understanding, shaping, or driving these trends. I couldn't be more proud to open this with a world-class expert, Dr. Victor Calanog. If I'd read Victor's full list of accolades, that would be as long as the time allocated for this webinar, so I'll just read a portion. Victor Calanog is the head of commercial real estate economics at Moody's Analytics. Before that, he was chief economist and senior VP at Reese, where he led a team of economists in forecasting, valuation, and portfolio analytics. His research has received awards from the Ford Foundation, the Russell Sage Foundation, the Penn Lauder Center, among other places. Victor's research on real estate economics, local government competition, and urban fiscal policy has been presented at the American Economics Association, American Finance Association, the Brookings Institution, Harvard, Columbia, Stanford, Wharton, and the Stern School of Business. Dr. Calanog's contribution and reviews are published in the Journal of Banking and Finance, the Journal of Risk Management Association, the Journal of Finance, the Journal of Public Economics, the World Bank Research Observer, the Brookings Papers, and Public Administration Review. The list goes on and on. I'm really cutting it short. Victor's assessment on what's going on in the market is continually discussed in places such as the Wall Street Journal, New York Times, Bloomberg News, Financial Times, and Reuters. Dr. Calanog writes several columns, serves in multiple boards, won more awards than I can count. He holds a PhD in applied economics and management science, as well as an MA and an MBA, where no surprises, he won even more awards. Dr. Calanog also has a book on Japanese robots in the 1970s. So that's a little fun fact, and thank you for sharing that with me earlier. Just a little bit about today's format. So we're going to go through approximately 20 minutes of presentation, followed by Q&A. Please do use the Q&A function in Zoom as you go along, and please do ask your questions as you go along. We will read them at the end. This presentation is going to be recorded and available later, so thank you to everyone who's watching this later. And with that, over to you, Victor.
Thanks, Ben, Kira, and everyone on the Cherre team for allowing us to share some of our thoughts today. It's been an eventful 2022 so far, to say the least, and monetary policy and rate hikes since February, though widely expected, really plays right into the narratives of and questions about, well, what's next for the economy, commercial real estate, and the CRE tech landscape, given everything that's going on. So let's get right to it. I'll start off with some thoughts on recent economic developments and key points we'd like to highlight. Then what I'll do is to transition and discuss specific property types and geographic markets of interest. We'll go a bit deep into industrial and office, and then address the burning questions that are likely to be occupying discussions in the near and long term. Issues about interest rates, inflation, where cap rates and CRE pricing are likely to go. We'll talk about ESG and CRE tech and whether it's made progress or not. So let's get right to it. Nothing kills a webinar faster than a slide with very small numbers. So even as I flash this image, remember, Ben and Kira said, you're going to get these slides afterwards, so don't focus on it. Guys, I put a jacket for you today, despite inflation of body weight, not transitory, and even shaved. So please focus on me as I tell you the story of where the economy is headed, because I'm here to tell you right now that we are already in a recession. No, I'm just kidding. We're absolutely not in a recession, but this past couple of weeks has been a real doozy. When inflation numbers were released last June 10, higher than expected, markets took a dive that following week, and then the Fed raised rates by 75 bips, something they've never done since 94. So our GDP forecast released in early June, you see it on the left-hand side of this chart. Well, it's already due for an update, and that'll happen next week. What also happened in late June was a cacophony of conferences. The CRE Finance Council had theirs in New York. The Mortgage Bankers Association had their chairman's conference out in the West Coast. I say that their investment committee, the real estate roundtable had their meetings in DC, and sentiment has definitely been turning more and more negative about the prospects for continued economic growth. But recessions aren't defined by volatile stock prices or the financial economy in general. A recession is defined by the real economy, jobs, and spending. And here is your canary in the coal mine. When the BLS releases their jobs numbers every first Friday of the month, the moment that number turns negative for even 1 month, meaning companies are laying off people and not hiring them, there's a 50% chance we're already in a recession. Second straight month of negatives, 80 to 85% chances. Remember, the NBER will only tell you that we've entered a recession in retrospect, 6 to 12 months after it's begun. But by then, you already have felt it in your pocketbook or your W-2. So I'll absolutely be on the lookout at 8:30 a.m. this coming Friday to see what's up. So we are not in a recession, but financial markets have been pulling back. I'll have a lot to say about what all this means for CRE capital markets. But for now, one last deep dive on a potential structural shift, given how unique the past couple of years have really been. One detail that isn't discussed much is how the lockdowns in 2020 shifted so much of our activity to goods purchases versus spending on services. We just weren't eating out or traveling, we couldn't. The massive shift in goods purchased for delivery exacerbated supply chain issues, and that contributed significantly to the core CPI spikes net of energy and food. So as we reopened, we're spending again on services and less on goods. March to March, real spending on goods was down 2.9%. By contrast, spending on services was actually up 5.9%. So what you can do is to look at the shifting numbers in a relatively positive way. A decline in demand for goods may alleviate inflationary pressures, while spending on services may keep the US economy growing. See, after I kept it real and gave you some doom and gloom, here I am giving you glass half full. Directly pertinent to our hotel discussion later today, leisure travel is still likely a large component of the numbers that you see in this chart, because we're just a shade below 2019 average daily volumes now, according to the TSA. We hit a recent high of 98.1% last July 1. So if you guys traveled over the 4th of July weekend, well, you helped. And it's been stable at around 90+%. Again, in reference to where average daily volume of airline passengers were back in 2019. Still, the waters do remain muddy. The Russia-Ukraine military conflict, that's helping keep energy prices relatively high, constraining not just discretionary travel, but also likely spending. Earlier, 2 slides ago, I just heard me strike a somewhat optimistic note about spending on services, but you've still got ongoing labor shortage issues. Households are likely to see elevated prices all the way from hotels that you wanted to book or summer camps for your kids. The Fed is committed, rightly or wrongly, to price stability, but that negative figure for GDP growth in Q1 and expectations of slowing economic growth really complicates its job of holding down inflation, because they're risking even more negative GDP growth numbers. Now, is it making a dent on price components? Actually, yes. So coordinated central bank tightening likely accounts for oil prices dropping below $100 yesterday, given some perceived slowdown in aggregate demand. But until we're back to around $85 per barrel, energy price levels still qualify as elevated, and you guys feel it at the pump. So the basic trend is that we've ratcheted down our expectations for economic activity. You've got the MBA dampening their expectations of things like mortgage originations, more on that later. But for now, 2022 was probably still a pretty busy year for most, but already not likely as busy as 2021. or busy in different ways. So with that, let's turn to different property types in CRE and how they performed. I'm going to share Q2 numbers where I can. So I know this slide is really hard to read, but you know why. I wanted to focus on me. Let me tell you, multifamily did not get the memo that first quarter GDP was going to be negative because performance metrics remained very strong. In Q1, vacancies were down to 4.7%. In Q2, it fell another 20 bips. So we're now down to 4.5%. That didn't make it to the slide because we just finalized that data yesterday. And I sent these slides to Ben and crew the morning of. And so you've still got rents growing at 2.7, 2.8% in the second quarter, well over 5.5% half year past. And so multifamily is likely going to end the year unless things turn rapidly negative at around a 6 to 7% rent growth, because we are already there halfway in the year. We really aren't seeing a lot of new construction spike because of ongoing supply chain issues, both on the labor and materials front. Decent supply side response, apartments are being built, but really robust demand from favorable demographics you've got rents growing year over year in excess of 20% for many markets. I'll wrap up with some more good news, industrial, before we discuss the property types that don't seem to have the brightest of futures. Industrial warehouse distribution vacancies, record lows at 6.1%, fell by 50 bips in the first quarter. Asking effective rents still up close to 2%, though that represents a slowdown relative to the middle of last year. Prospects are still so strong for industrial that, in fact, industrial lease terms have begun to decline. So in a paper that Dr. Ermengarde Jabber from my team published in late March, she and colleague Ricardo Rosas showed how lease terms began to decline around 2018. That matched the spectacular growth of rents and occupancies in industrial. After all, why would you lock yourself to a 10 to 20-year lease with 2 to 3% escalations per year when rents appear to be rising that much in a quarter or two? But what about the office sector? Well, the outlook isn't as sanguine for obvious reasons. A lot of companies now have returned to office measures in full swing, but in the US, physical occupancy remains mired at the national level at around the 40s. There's a lot of variation in markets. Texas markets are in the 50s and 60%. New York and San Francisco down in the mid to high 30s. And that's up from 10 to 15 percentage points versus where we are this time last year. Still, I'm stating the obvious here. This is a property type that's in the midst of a longer term transition. Performance metrics wise, you had office vacancies at 18.1% in this chart, but it's back up to 18.4% as of the second quarter. Again, late breaking news. Maybe occupancies are being a bit shaky because now more than ever, a lot of employers are probably thinking, hey, do I let go of my office space if a lot of my workers don't seem to want to come back? Now, how is this playing out at the employer level? Companies have continued to delay returning to the office. As this mocked up chart speculates, the longer we delay a full return, well, the higher the chances that large parts of our workforce will become permanently decentralized. That's why our forecasts have vacancies remain somewhat elevated for the next couple of years. At the tenant level, a lot of smaller tenants are signing shorter or what we call bridge leases. Almost 1/3 of leases signed in 2021 were for 1 year or less. You've got smaller tenants sensitive to real estate costs, so they're understandably reluctant to sign up for longer commitments if they're just continuing uncertainty of where their workforce will prefer to be. Unfortunately, this so-called trend towards shorter leases, if it continues, that does mean higher rollover risk. And even as early as 2021, we were seeing spreads kind of blow out for office space, particularly in the suburbs, because of these continuing uncertainties. Retail, similar both to office, steady in the first quarter, steady in the second quarter, still weak. Rent growth basically 0 to 0.1%. You've got mall data on the bottom right-hand side. Sure, 11% vacancies, down from 11.2%, a recent historic high. Still relatively elevated, though it's more of a world in have and have-nots, because you do have outperforming malls, the SPGs of this world, for example, that post vacancies sub 5%, which does make you question about those malls in the other side of the road, which make up for that remaining 15 to 20% of vacancy rates that well-performing REITs don't quite have. Take a look at the national hotel market. In this slide, you've got that pandemic-driven pendulum really continuing to swing wildly, right? You see that. occupancies fell from 64% down to 51.9% in late 2021. You can thank Delta and Omicron for that, but then it roared back to close to 62% by the end of the first quarter of 2022. But then you've got ADRs, or average daily rates, declining by 2.6% in the same period. So a lot of hit and miss for the office sector right now. The hotel sector. You do have a lot of hotels in the Miamis of this world, for example, actually posting record highs in terms of average daily rates, because they're both a leisure destination as well as a returning conference destination as business travel continues. Again, a lot of volatility, at least with travel ramping up. Hotel performance metrics may well catch a much needed break from volatility, hopefully for the rest of the year. For sure, we did see some pretty good air travel numbers from the July 4th weekend. So let's talk real quick about CRE capital markets. My suspicion is a lot of the near-term effects of rising interest rates are going to show up here in cap rates, pricing, and transaction volume. We're already seeing cap rates show a sign of response to monetary policy tightening. They experienced a small bit of an uptick in Q1. That's a trend that we unfortunately anticipate continuing, albeit there might be lags to the aggressive monetary policy tightening and rising risk-free rates. The lag is because cap rate spreads over the 10-year treasury have some room to compress. And then if 10-year treasuries blew out to close to 3.5% last June 14. Well, guess what? Today it's hovering between 2.8 and 2.9%. So it's that oscillating risk-free rate that actually, I think, makes it difficult for both buyers and sellers of commercial real estate to make decisions. Are prices going to fall when risk-free rates rise? Or are they going to decline now that the 10-year treasury is back down below 3%? It's that oscillation, I think, that makes it difficult and might put a bit of a freeze on transaction markets. Speaking of transactions, back in 2021, lending in multifamily and CRE set new highs. The MBA reported a record $900 billion figure. As recently as February, they were forecasting originations to exceed $1 trillion, but they ratcheted that down to flat $895 billion for 2022. My suspicion is that will also be ratcheted down further if trends continue. They've already shifted their residential mortgage originations forecast to be anywhere from 30% or more below 2021 levels. And I know we're slip sliding again towards negative sentiment, but let's just remind ourselves that CRE markets actually did really well through the pandemic. Defaults were very low, except for hotel and retail. The average number, the overall figure, you could see here in this chart, that light green line was basically barely above 2 to 4% and back down to 2% as of the earlier part of this year. The recovery was also exceptionally strong, even for hotels. That's that massive dip, in the historic dip, actually, in that gray line that you see in the very right side of this chart. It took a massive nosedive during the early months of the pandemic. No surprise, really got hit with lockdown policies. But take a look, it really bounced back up well over the zero horizontal. And you've got industrial and multifamily not even dipping below zero based on these total returns measures, or NPI, from NCREIF. So before we end my spiel, I wanted to touch on the ESG conversation. It really has been gathering steam over the past couple of years, and it's very much related to recent CRE tech introductions and prop tech considerations. Last year, ESG issues, really more environmental more than social and governance, reached what I'd call a watershed moment for commercial real estate. In particular, the conversation centered around green lending on the opportunity side and physical and transition risk on the risk side. So this is what we mean when we talk about the opportunities and risks that climate change presents to CRE lending and investing. You've got a lot of finance sources getting into the game. You've got big players like Fifth Wall investing in climate-related technologies. So things like technology that allow energy monitoring and near-term payback energy retrofits. One estimate I've seen puts it at 80% or more, the number of prop tech innovations related to climate risk as a percentage of the total. We've also been involved in many discussions, I'm sure Ben and crew have been as well, with industry standards organizations to really figure out what resilient and sustainable means. A lot of work needs to be done, and we're not sure whether a recession in the near future might put this on the back burner, but let's close out with just 3 key takeaways, and then we can move on to Q&A. Number 1, geopolitics, inflationary pressures, and policy. They're all coming together in a real volatile mix. Chances of an economic slowdown have risen from a baseline of 10 to 15% in any given year to 33 to 50% over the next 12 to 18 months. Statistically speaking, that is worrisome. And you know that canary in the coal mine, those jobs numbers, the BLS releases every month. Number two, income drivers on the CRE side, rents and vacancies, have yet to get the memo that things are slowing down. So I think you will feel its effect on the capital markets, transactions, and cap rates as cap rates begin to rise and riskier assets like those stock investments that you might have had are repriced. The strategy appears to be for a lot of our clients, focus on quality assets with strong income potential to ride out any volatility on the valuation side. Finally, number three, is ESG here to stay? I guess we'll see just how committed firms are to goals like carbon neutrality. To be fair, this was gathering steam before COVID, and though it got put in the back burner during the times of highest panic at the start of the pandemic in 2020, it really made a comeback and surge in 2021. So I'm really interested to see what happens in the very near future. So I'm going to end now because I can talk for 2 minutes or a full 2 days, but I believe there are questions that need to be asked. Then I'm going to turn it back to you guys and we can have a fun conversation for the rest of our time.
Thank you very much, Victor. And, you know, I was smiling as you were talking because normally when I hear a podcast or a webinar, I put it on 150% speed or 200% speed, just so keeps me awake. But with you talking, I'm like, this is just the right speed for me. I might even hear it again at like 80% speed. So I appreciate that.
It was at 1.5x speed because usually my voice is much more baritone than that. So, you know, the pitch got higher, right?
Thank you very much for that. No, but really, it was nice to see for our opening inaugural event, such a coverage of the various asset classes. So I want to take a little bit of an aside and talk about data and tech, and then come to the various more towards economics. I want to ask you first. I've heard you talk in another place about fast data and slow data, and can you explain a little bit about what that means when you use each and so forth?
That's a great point. Quick history lesson. It was not till 1999 or the year 2000 that the commercial real estate industry started publishing data on a quarterly basis. Prior to that, it was all annual because for a lot of CRE lenders and investors, that's all they needed, annual data points. So to go from quarterly to monthly really does reflect, I think, that demand for more information in a more updated and real-time way. And I do think that a lot of the innovations we're seeing in fast versus slow data comes in those high frequency data points that we can marry to slower moving data points. Things like a property, for example, a property doesn't get up and walk, right? But if you can marry things like mobile phone data on foot traffic, I do think that the innovations we've seen would be to rethink things that were formerly static, things like submarket boundaries, right? So if you've got a neighborhood, Ben, let me just illustrate, and I know Cherre's data is all about this, putting together all these data sets together, right? If you've got a property at the border of a submarket, right? How do we know that the customers patronizing that retail store actually don't come from other neighborhoods? Before higher frequency data and foot traffic data, you couldn't make that determination. So you cut up neighborhoods based on land. But actually, we may be evolving towards, you know what, that property is doing well because it has the capacity to attract people from other locations aside from where it's currently bucketed. And so I think that's what excites me these days, the potential of higher frequency data. And there's a lot of noise out there, right? So we've got to work together for platforms that bring actionable insights to fast and slow data and figure out how to make better decisions from there. Does that make sense? I'm going to bounce it back to you.
Absolutely. And you remind me of, I interview engineers and they say, okay, real time. So do you need it like in 500 nanoseconds and I say, no, once a day is good enough, right? That's real time in real estate. And as you're sharing, right, even quarterly is a bit of an innovation, right?
I think so. I know there's a second edge to this sword, shall we say, right? Like at a time of super high volatility and rising interest rates, do you really want to revalue your properties every day or every hour as interest? Like, is it a frequently traded stock, or is that multifamily building that you're in? Are they really losing tenants, right, in real time? And so it's an open question, and I think a lot of lender clients will push back and say, no, we don't want to mark the market more than X times a year. Back to you.
So is there a particular data set or a way of gathering data that you find more exciting recently? Like something that you 5 years ago wouldn't see coming in terms of how data is collected, a new application, a new data source, a new feed?
Well, I think the way I'd like to answer that is, number one, from a commonly available data set point of view, right? Because I can refer all the time to all the efforts that Moody's and other companies are making for unique data sets. I get that. But things that are commonly available now, like daily TSA downloads on airport traffic, a chart of which I showed you there, that's not exclusive to us. Those are data sets that the TSA itself started releasing during the time of COVID. And so to the extent that more information means hopefully more thoughtful decisions, there are commonly available data sets out there, sometimes even released by governments themselves. New York City, for example, actually has an incredible property level database on whether or not specific buildings meet climate standards, right? That's actually available for folks to check out. But then, Ben, I think the value here comes from when we're able to really connect the pipes well, because the preponderance of data out there also means that we're slip sliding towards a world where we're frustrated if we don't get data points for free with a simple Google search, right? It's like, if I pull it up on Google and I don't get it for free, it's almost frustrating. Does that mean data is being commoditized? To some extent, yes. What's not being commoditized, I think, and this is where the opportunity is once those data sets are married together, once those pipes are combined properly, and it generates actionable insights, man, that's what you pay for, right? That's what gives you an edge. If everything else is commonly available and I heard one client say, I don't want data to be commoditized because it's my advantage, right? The superior information is my advantage. To the extent that the playing field is being leveled in one way, we are forced to look for value elsewhere. And that's where platforms, workflow tools, platforms like Cherre that put together things in an easily digestible way, that's, I think, where the value comes from.
Thank you very much, Victor. And by the way, I learned that you bring a person, you put them on the podium, you never know what they're going to say, good or bad. But thank you for saying these nice things about Cherre. I really didn't expect it. And for the record, we did not prep this, right? For the audience,
we did not prep this. This is not like, I'm not reading off a chart here. Yep, go ahead.
Thank you very much. I'm wondering whether, do you put much stake in the data that companies themselves have, right? Because what we've seen is companies hold a lot of data and it's very relevant and it's data that they trust, but it's about a small percentage, a fraction of the economy as a whole, right? And now you have to marry up what they know is true about the world because they've collected it, but it's a small fraction versus what the world has to offer. So how do you think about that?
Yeah, that's a great question. I think more and more companies are realizing that they are sitting on a treasure trove of unique data points that they themselves are collecting. You've got a lot of asset management and property management firms that are collecting operational expense information on specific buildings in their portfolio that they can now use, if they can tap into it, to benchmark against specific neighborhoods. So now it's not, oh, we were able to raise rents by 8%. Well, relative to our submarket or neighborhood, that's good/bad, right? Well, it's good if the submarket grew by 2%, maybe not so good if the submarket grew by 15%. So it is, I think, more of a greater realization that, hey, if we have data to exploit, then that's great. Of course, I'm preaching to the choir here because that means greater demand for labor like myself and others who can put all of this together and provide insights to their employers. The danger here, I do think, Ben, is are we committed to really harvesting insight from that data? Or is it really more a nice to have because we've been doing well and we're profitable And it just kind of sounds nice to our investors if we can say we have a chief data scientist or we're investing in this. And I think one needs to be very thoughtful about making sure that it's not just an exercise in delight, right? Because it's sexy at that time, but more like, hey, this is important to our business. Look at how it's helping us make better decisions. We're not overspending. And if we encounter a recession, it's not the first thing we're going to cut because everyone has to cut, right? So I think we do have to tread that fine line about, it's easier for Moody's, I think, to say, well, that's what adds value to Moody's clients, information and analytics, right? But for a brokerage firm or a bank, is it still going to be perceived as more of a cost center, a nice to have, or is it going to be, gosh, this is really helping our business? Back to you.
Thank you. And yes, we have seen that, right? Part of our way of qualifying deals is making sure that clients are really seeing this as a key part of their strategy going forward as they grow and building a team around it and so forth. One more question for me, and then we have a number of questions from the audience. So, can you trust and how important is Bureau of Labor Statistics, BLS data, these days, especially with what went on with the political situation around how this data was collected in the recent round. So, and how important is that BLS data to the mix relative to all these other data sets that are available now?
Yeah, I do think that it's still important to the extent that it's our quote unquote official measure of important data point, non-farm employment, not even office using employment, right? You get very specific on that. And what I need folks to know is that you do want to be smart and informed about data sources and data quality. A lot of people are shocked when I say that the BLS comes up with its jobs number with a 0.5% sample. Right? They don't have the time or resources to actually touch base with the 120 million households in the United States. So they sample 60,000 every month, which by the way is a pretty big number because they're literally trying to cover 2,000 households a day, right? But it's still a really small sample. And that's why there's always some kind of statistical error built. You don't need a PhD in statistics to know about this. You just need to realize that any data set out there is likely to have its biases given how it's collected. And so the more important thing is really for us to take a look at multiple data sets. We see different parts of the elephant, and then we can make a decision. Okay, it is an elephant. Oh no, it's a snake. Oh, it's going left. Oh, it's going right. Then I think it's that read of the tea leaves that, oh, and by the way, all credit to the US government for this. Why does the US government not offer recession projections, right? They only tell us about it after it's happened. Well, number one, they know that they're the voice of authority. And the moment they intimate that we might be reaching for something, they might precipitate it, right? So they want to avoid that. They want to be careful about it. And sometimes it's simplified. Like folks say, oh, a recession is 2 quarters or 3 quarters of negative GDP growth. No, actually, the NBER does a ton of work looking at least 6 other personal consumption expenditures, household income, industrial production, and so on and so forth, right? That's off the top of my head. They're trying to read the tea leaves, and the more reliable tea leaves we have in that mix, I think the better picture we'll have about where we really stand. And so, again, I know it's kind of self-serving. The more data points you can use to make your decision, the better you'll be. As long as you can separate the wheat from the chaff. Back to you, Ben.
So I hear you saying that BLS data is important, but we don't need to rely on it so strongly anymore as we did in the past because we have all these other data sources.
I hope so. I do hope that means progress, right? I do hope that it's not that we're reliant on a single source of truth. I've never said that on our data points have limitations, right? Everything all I presented are fancy PowerPoint slides, but please let's have that conversation about how, oh, our multifamily data only includes market rate rentals 40 units or more. Well, what about that 8-unit brownstone in Brooklyn that I really want to invest in? Well, that's not in the data I presented. Let's have a different conversation about it. So let's be smart about all of these things that are being fed to us, and then we can have a meaningful conversation. Back to you, Ben.
I'm going to take some questions from the audience. So are you aware of any office REITs that publish their data weekly it has to do with worker occupancy based on badge swipe, similar to how Castle system does. I'm asking because in my market, which is New York, I understand that Castle has very few buildings to draw the data from. Thanks.
Yes, so just for full disclosure, I do know the folks at Castle quite well, and I've interrogated their data quite a bit. I'll tell you right now, for example, that they didn't quite take that snapshot before COVID. I think because they're a security company, they actually can't keep some of those data sets stretching back in time. So for those of you who are saying, oh gosh, well, what was physical occupancy via Castle before COVID? Well, you're not going to get it. They index it to 100% before COVID, and then it drops to like, whatever, 15, 20, and now it's back up to 40, 45. So talk about limitations. And yet, to your point, Castle is now perceived to be quite the authority when it comes to physical. No one cared about physical occupancy before COVID, but now it's an important thing for the office sector. Newsflash, a lot of office REITs and brokerage companies are trying to track not just security swipes, but actual physical presence and where you are and where you gather in offices. Do you sit in your cubicle or do you hang out by the couch or the kitchen? A lot of it's still pretty internal. And so, Ben, this is related to your question earlier about what companies can do to harness internal data sets. A company like WeWork has been doing this before COVID, right? Because WeWork's pitch is, we can tell you where your workers are likely to gather, and therefore, why don't you lease space from us? They have heat maps that show that, X hours of the day you were by that stairwell. I don't know, maybe you're smoking. I don't think they quantify it that much, but they do make distinctions about just ID swipes, which just means you're in the building, versus actual physical presence, which is great. Unfortunately, I really don't think they publish it systematically, as opposed to using it as a resource internally to optimize their own operations. You're kind of going to have to knock at the door of these REITs to go and say, hey, are you trying to measure this? Back to you, Ben.
Another question from Alice on our team. Which near real-time data sets are you most excited about in the industrial sector or the logistics sector, and why?
So I don't see a lot of people taking a look at trucking data and trucking volume for logistics. Things like TEUs for ports and whether or not that's dropping or falling. That's not necessarily near real time, but it's certainly overlooked, right? It's where activity is slowing down because of West Coast strike negotiations. And that will directly impact things like whether there's demand for nearby industrial space in the inland empires of this world, where there might be 1 billion square feet of warehouses. And so those things that used to be the purview of the intermodal transport system, like buses and trains and so on and so forth, they're getting a second look now because of the rise of logistics. So that, I think, is pretty interesting for industrial space. Aside from that, really it's listings data for whether or not that's the tip of the spear, right? That's not your in-place income, but it is when things like sublet data that we collect on our end as well. Like if that thing's rising, then you're getting a sense that, you know what? Oh yeah, Amazon is subleasing more of their warehouses. They're not using it. They overcalculated, they overbuilt. It's just been in the news for the last couple of weeks or so, right? And so I love those data sets that show, even if it's not systematic, even if it's only X%, it kind of shows then we can make a decision whether such trends are idiosyncratic or if it's becoming system. If it affects one market, maybe that's a Chicago thing. If it starts to affect 2, 3, 4, 5 markets and it's only been a week, then I start looking further. Does that make sense? So it's like it's the data flow over time and how quickly those changes are coming are always things on my mind. Thanks, Alice.
Thank you.
With a Y, right? Alice with a Y?
Alice with a Y, that's right.
I love that.
And she helped me prepare for this series, so I really appreciate that. Thank you, Alice. Same question about CRE transactional data. So what are the best sources of near real-time CRE transaction data?
Now, there are a lot of folks that collect transactional data, but a lot of them from titling companies, places like CoreLogic and First American. That would be your first step, my suspicion is, when it comes to overall numbers, comprehensiveness, right? But where we need to dig into it is whether or not those comprehensive numbers fit into your bucket of investable space. That's a complicated way of saying, it's great that you think $1 billion of transactions happen in industrial, but X% of it was manufacturing. And I don't care about manufacturing. I only care about warehouse, right? Or flip that number around. And so it does become this game of, right, even for the big transaction, even if you buy it and it's comprehensive, well, okay, how do you curate it now? Because we really only care about this slice of the market. And at this point, the pressure is on both sides. You need to be both comprehensive and curated, because more often than not, your clients only care about this part of the market, right? Not the entire thing. Back to you.
Sounds good. So one question from the audience. Do you have a good source of information on flexible workspaces and office subleases?
Yes, on our end, we do collect office subleases. So that's an embarrassing pitch for what we do. Now, with that said, for flexible workspaces, I've seen some larger brokerage companies try to get a handle on this, but I haven't seen one that, unless WeWork publishes their own numbers, because that, is it really WeWork plus Regis plus every building that CBRE and JLL are helping manage now as they get into the flexible workspace game? I haven't seen that what ends up happening is I do talk to all these sources. A lot of them are our own clients, and a lot of them have chief economists who may or may not have worked with me in the past, right? And so those are the first phone calls that I make, especially. And by the way, here's the thing, right? I'm very fortunate that I have folks like you. We collaborate with folks at Cherre. We collaborate with the broker. But we do have to acknowledge, okay, what do we not know? And what do we need to learn? And I think the big mistake is, oh, we're so plugged in, we really know what's going on. And then something catches us by surprise because we weren't open to like taking a look at other sources. You guys might probably, things like life sciences, right? That's the new big thing. Who has like comprehensive data on what life sciences even mean? Do chemical processes like fall into life sciences? What do life science buildings look like? It could be 100. Do you need like doors that lock because of security, because it's biological experiments, right? And you have, I don't know, monkeys or rats that you need to keep caged. It's an evolving conversation, but I think the collaborative enterprise of figuring out the information behind it is exciting for me, especially when it's not commoditized, right? We're forging new ground here. It's really exploratory. Back to you, Ben.
Thank you very much for that. I want to say I see more questions coming up. We're not going to be able to get to those, but I will say, please do send us those questions. I see anonymous questions, but I'd love to know who you are, because Cherre has additional data sets that we could talk to you about. Not ours. We'll refer you to the relevant source. And we have teams that deal with that. So please do send those questions our way. I'm also happy to send those questions to Victor after the webinar. One last question for me, which is this. Can you tell me just a little bit about your book about Japanese robots in the 70s? I just have to know.
Well, thanks, Ben. So I'm not sure a lot of people know about this, but it was in 1972 that a Japanese creator introduced a giant robot that was piloted by a human being within. Now, of course, it's pretty much mainstream. You've got the Gundams of this world, which comprise 90% of all plastic models out there, big market, and so on and so forth. Anime is very much mainstream, but I had fond memories of this in the 1970s. And so when lockdown happened, I figured I'd introduce my kids to it. We'd have fun stuff to talk about. It was a fair trade. They ended up watching my mecha shows from the 1970s and the Gundam series, and I ended up watching their shows like Naruto and now Dragon Ball. And so that might well be my next book, about the philosophy of Naruto and Dragon Ball. If anyone wants a webinar about that, we should organize that as well. Back to you.
Looking forward to that. Thank you, everyone on call. Please follow Victor and his team. There's really a great team at Moody's, and they put amazing content out all the time. So please do give them a follow. Thank you very much, Victor. Thank you, everyone watching us today and watching us later as this gets posted online. Victor, I really enjoyed today's conversation. I learned a lot. Thank you. Bye-bye, everyone. We're going to end it here, and we're going to post this online.